Hi, I'm Jim and I was retired. Today we're diving into the one big beautiful bill signed into law on July 4th, 2025 and what it means for your taxes. So on this 4th of July, let's go into the 4 major tax changes for seniors. Stay tuned. Now, from permanent tax brackets to a $6,000 senior bonus that's temporary, we'll break down the 4 biggest changes for retirees. Stick around to the end where I'll update a tax comparison chart. And don't forget to like, subscribe, and hit that bell for more retirement advice from a DIY retiree. Let's get started. All right, so I'm going to be sharing, as I do always on this channel, some research where you can do your own due diligence too, including a TurboTax insights on the new law. I want to concentrate on just 4 changes that you may find apply to your DIY retirement. If you are a DIY retiree like me, you may have received an email from the Social Security Administration that said no tax on Social Security. Or you might have seen press accounts that say there's no tax on Social Security. As I've covered before, that's not quite true. We'll debunk that myth, but get down to the facts about how this affects your taxes. Let's begin with the big change for seniors in the new law. What the big beautiful bill did was to make permanent the 2017 tax brackets and deductions. And that is the biggest thing. They were set to expire at the end of this year, and we would have reverted to tax brackets that were much higher. Now, we're going to have the certainty of knowing that these tax brackets that we're dealing with today in 2025 will remain. Yes, Congress could change them, but there is no sunset provision in these new tax changes, so they become permanent until some future Congress changes them. You know, for instance, suppose the law expired. The 12% tax bracket would suddenly become a 15% tax bracket next year. That bracket will index with inflation, but the 12% tax bracket, and more importantly, the 22% tax bracket, remain in effect. DIY planning tip: you're going to want to plan your retirement income as much as you can to stay in that 10 to 12% tax bracket. But if you go into the 22% tax bracket, you're sure going to be glad it's 22 and not 25 and 28%. So the second major change is an enhanced standard deduction for seniors. The current law had a $30,000 standard deduction, and that's been boosted by a $6,000 per senior bump to the standard deduction. Now, that's going to be a temporary change, unlike the regular standard deduction, which is now made permanent. The bonus senior deduction of $6,000 per senior is temporary and will stop after 2028. As I explained in a prior video, this bonus senior deduction is on top of the standard deduction and the senior boosts that are already currently written into the law. For instance, there's a $1,600 per person boost to the standard deduction. Well, in effect, it becomes that $1,600 plus $6,000 on top of the standard deduction. Now, there are boosts to the single person. I'm covering married filing jointly because that's my retirement. But understand that the $6,000 bonus is per person, and it's $6,000 for a single filer as well. So this bonus deduction for seniors is in lieu of changes to no tax on Social Security, which they couldn't cover with the law. And it's temporary. It only goes through 2028. Here's my idea. Why doesn't Congress address the funding of Social Security, and while they're doing it, lessen the taxation of Social Security? The brackets that allow 85% of Social Security to be taxed as income weren't changed since the law in the 1980s. No tax on Social Security is not in the bill, but this senior bonus deduction plus the enhanced standard deductions add up to a significant tax savings for seniors, especially DIY retirees like me. And they apply whether you're on Social Security or not. So since I'm waiting for 70, these will affect me this year and next before I file for Social Security. By the way, here's another DIY retirement tip. If you can, keep your AGI below 150,000 as a couple, because then this bonus deduction will fully apply to your taxes. It starts phasing out above that level and phases out completely at a significantly higher AGI. Now let's cover the third big change for DIY retirees in the new law, and that is the raising of the salt deduction. And I did use a little bit of salt on these chicken legs I'm grilling here. But SALT here stands for state and local taxes. And under current law, there was a $10,000 exclusion. And 90% of the people didn't itemize their deductions and couldn't take advantage of it anyway. Well, they've raised that $10,000 to $40,000. And it applies only for a certain number of years. So you'll want to do your taxes carefully to see if itemizing makes sense for you with these higher deductions for state and local taxes. Now, in my case, I'm not sure it will apply. Down here in South Jersey, our property taxes are not as high as they are in the suburbs around New York City. But if you're in New York or California, you might want to look at your taxes this year. So the fourth big change for DIY retirees in the new law is a dramatic increase in charitable donations deductions if you use the standard deduction. It used to be you had to have itemized deductions to take much of the charitable donations off your taxes. Well, and they did have a token standard deduction for charitable. I think it was $600 for a couple. Well, that's increased to $2,000 for a couple, $1,000 for a single filer. That means that if you don't itemize, if you stay in the 90% of us that won't itemize, you can still take some deduction for your donations to charity and churches. You know, for instance, a couple that donates $2,000 to their church and they take the standard deduction, they weren't able to deduct that donation on their taxes. Well, now with the $2,000 limit, that'll save them about $240 a year if they're in the 12% tax bracket. Check it out in the next few years. And again, this is temporary. It ends in 2028. So take advantage of this tax law change in your planning in the next few years. Now let's look how the new tax law applies to the sample couple we've used in past videos. Both are 67 and are collecting Social Security. The husband also draws a $25,000 pension and takes $40,000 from his IRA. They have $10,000 in dividend income and $5,000 in interest income. He gets $24,000 a year from Social Security, while his wife receives $12,000. That totals $36,000 for the couple. 85% of that taxable, or $30,600, their adjusted gross income is $110,600. Now let's dive in on how the one big beautiful bill changes their tax picture. Now I've updated this chart in two ways. One is to add this bottom row with the final HR 1 provisions and a column here for charitable donations. Now the couple gets the full larger standard deduction, their senior deductions, the temporary senior bonus of $6,000 each. Now that senior bonus has some income limits on it. It starts to phase out above $150,000, but this sample couple would qualify since their AGI is below $150,000. I've also incorporated a $2,000 charitable deduction for 2025, which they can use taking the standard deduction. That brings their total deductions for 2025 to $48,700, and their taxable income is now $61,900. So their total savings versus the current law before the passage of the One Big Beautiful Bill is $1,860. No taxes on Social Security would have saved much more, $2,832, but that was not feasible under the Senate's reconciliation rules. But far worse would have been the option of letting the Tax Cut and Job Act of 2017 cuts expire, which would have raised this couple's tax bill by more than $2,500. Several viewers have requested that I look at how the One Big Beautiful Bill applies to a single retiree. So here's a sample 67-year-old woman who's collecting a $25,000 pension, takes $25,000 from IRAs, has $2,500 in interest income and no dividend income. She collects $25,000 a year in Social Security, and because of her other income, 85% of that amount is taxable. So her adjusted gross income is $73,750. Now let's look at the tax scenarios for her case. In her case, the final law increased the standard deduction to $15,750, and she's entitled to the $1,600 senior deduction plus the full $6,000 senior bonus, since her AGI is below the $75,000 limit for a single filer. She's also donating $1,000 to her favorite charity and can use that deduction along with the standard deduction, and that brings her taxable income to $49,400. So her savings compared to the current law is $930, and that's far less than the $2,550 she would have saved if there was no tax on Social Security. But again, that wasn't feasible. And again, it's far better than paying $1,840 more in taxes if the 2017 tax brackets had expired at the end of this year. So in conclusion, the four big changes are the permanence of the tax brackets. And yes, I know not everything is certain, but permanence, meaning no sunset to these tax law changes, gives us certainty in planning our DIY retirement. The second big change is the bonus increase for seniors for the next few years. You can use those to lower your tax bill. The third is the temporary change in SALT, state and local tax deductions for the next few years. And again, that fades back down by 2030 to a $10,000 cap on SALT deductions. But for the next few years, it'll be $40,000 and index up. And then in 2030, it'll go back to $10,000. Use that. And the fourth big change is the change in the charitable deductions for standard deduction users. If you don't itemize, you can take advantage of some of your giving. Hey, if you found this helpful, please like, share, and subscribe to this channel. So in conclusion, please ignore the hype. No tax on Social Security didn't make it into the law, but there are significant changes for your tax bill. Use them appropriately. Remember, I'm not a tax professional. I have no initials after my name. So take these as entertaining ideas from one educated consumer to another. Always do your own due diligence and seek out a tax professional to explain these more. See you later.